Welcome to the Pink Door Podcast. Welcome to the debate. Today, we are diving deep into the February 2026 real estate market update for Halifax, Massachusetts.
Right, and we're drawing on some highly granular data provided by MLS PIN and Pink Door Properties to really figure out what is happening beneath the surface in this specific geographic micromarket.
Exactly. The central question we are exploring today is this. Does the February 2026 data for Halifax indicate a rapidly accelerating hyper-competitive seller's market, or are there hidden indicators of market softening and buyer resistance that are just being disguised by historically low inventory? I argue that the structural lack of inventory and the extreme velocity of new pending sales prove the Halifax market remains fiercely competitive and heavily favors sellers right now.
And I argue that despite that low inventory, if you look at dropping median sold prices and the increasingly stagnant days on market for active properties, it reveals a cooling market. Buyers have finally reached a hard affordability ceiling, and they are pushing back.
Look, I think we have to start with the elephant in the room here. The macroeconomic picture painted by this February data shows an absolute sheer lack of available homes. The supply constraints in Halifax right now are not just tight, they are historically severe. The months of supply of inventory has plummeted to a mere 1.38 months. That represents a 26.6% drop just month over month and a staggering 42.5% decrease year over year. To put 1.38 months of inventory into perspective for anyone listening, a normal balanced market where buyers and sellers have relatively equal footing sits somewhere between 4 to 6 months of supply. We are looking at a scenario where if no new homes were listed tomorrow, the entire town of Halifax would be sold out of real estate in about 6 weeks. It's like a grocery store completely running out of bread by Tuesday morning. The shelves are bare, and that absolute scarcity is driving aggressive, unquenchable buying behavior. Just look at the sold-to-list price ratio. It sits at 101.2%, which is a 1.42% increase from just last month. Furthermore, look at the median days on market according to RPR, the Realtors Property Resource data. Homes are going under contract in a blistering 2 days. 2 days. That's a 50% drop month over month. The narrative here is mathematically undeniable. When a properly priced property hits the Halifax market, it is absorbed almost instantaneously and routinely above asking price. The structural deficit of housing units guarantees that sellers dictate the terms of engagement.
I come at it from a slightly different way. I certainly acknowledge the profound lack of inventory you are referencing. 1.38 months of supply is incredibly tight without question. The grocery store shelves might be bare, to use your analogy, but focusing solely on the speed at which a few select loaves of bread fall off the shelf, well, it masks a much more troubling trend regarding valuation. If this were truly an unquenchable, hyper-competitive frenzy, prices would be escalating synchronously with that drop in supply. Instead, we are seeing critical price contractions. The median sold price for Halifax dropped 4.1% month over month, down to $445,830. And if we look beyond the curated MLS data, which often filters out certain types of transactions, and we examine the sold public records, which captures absolutely every transfer of deed, the median sold price took an even steeper dive. It went all the way down to $349,900. That is a 20.5% plunge from the previous month.
I think we have to be careful with the public records data, though, because that can include off-market family transfers, distress sales, or teardowns that heavily skew the number downward.
That's a fair point on the public records, absolutely. But even the standard MLS median dropped over 4%. And more importantly, there is a glaring discrepancy in market velocity that completely contradicts your narrative of a buyer frenzy. Yes, new inventory might move quickly if it's perfectly priced, but look at the properties that don't sell in that first opening weekend. The 7 total active listings currently sitting on the market are averaging 84 days. That is nearly 3 months. If buyers were truly desperate, they would be scooping up those active listings regardless. But they aren't. This data reveals a massive shift in buyer psychology. Buyers are becoming highly selective. They are strictly enforcing their own affordability ceilings and outright rejecting anything they perceive as aspirational pricing. They are perfectly willing to walk out of the grocery store empty-handed rather than overpay.
I see why you think that, but let me give you a different perspective on that discrepancy between the 2-day median we see in RPR and that aging 84-day active inventory. You have to separate the actionable market from the stagnant market. The velocity of the actionable market is ferocious right now. Let's look at the pending listings data. We had 11 properties go pending in February. Those 11 properties cleared out over $4.48 million in total market volume. Now, the data shows they did so with an average days on market of 50, but we know that 50-day average is heavily skewed by a few stale properties finally capitulating on price. The underlying fact remains that when a property is properly positioned in Halifax, it moves in 48 hours. The broader absorption rate proves that demand is robust. Buyers are absolutely out there, and they are well capitalized enough to push the overall sold-to-list ratio over 100%. The fact that a handful of active properties are sitting does not indicate a cooling market. It simply indicates a few sellers who have fundamentally misunderstood the market's parameters. A bifurcated market where correctly priced homes sell in 48 hours above ask, while vastly overpriced homes sit, well, that is still inherently a seller's market. It just requires the seller to participate rationally and price accurately from day one.
I'm sorry, but I just don't buy that. Let me tell you why that bifurcation argument actually supports my thesis entirely. Let us dissect that active listings table precisely because it exposes the hard limits of seller pricing power in Halifax right now. In a true, heavily seller-favored market, precision execution isn't required. If demand were truly unquenchable, even slightly overpriced homes would eventually be swept up by desperate buyers who just keep losing out on those massive bidding wars you're talking about. The overflow demand would absorb the stale inventory.
Right.
But that isn't happening. Let's look at the specific tiers. In the $500,000 to $599,999 range, we have a property sitting for 124 days. In the $600,000 to $699,999 range, 3 properties are averaging 145 days on the market. These are not just brief hiccups. These are listings that have languished for a third of a year.
But those are the higher price tiers for this specific market. The median is in the mid-400s.
Exactly. The buyer pool at those higher price tiers has simply evaporated or straight up refused to engage. If a seller has to price flawlessly down to the dollar just to avoid sitting on the market for 5 months, they do not possess absolute leverage. The 84-day average for active properties is the market's way of establishing a firm, unyielding ceiling. It shows us that buyer desperation, the kind we saw a couple of years ago, where people waived every contingency, has been replaced by buyer discipline.
That's an interesting point, though I would frame it differently. The properties sitting at 145 days in the $600,000 range might represent an upper bound for Halifax, sure, but they do not define the forward momentum of the core market. To understand where the market is actually heading, we need to look at forward-looking indicators rather than focusing on lingering, stagnant inventory from sellers who missed the mark. Consider the new pending listings. The median list price for these newly pending properties is $497,000. That is an 11.1% increase month over month. When we look at overall pending listings, the median list price climbs even higher to $504,000, which is an 11.9% jump. This is the pipeline. This represents active, current agreements being struck between real buyers and sellers today. It demonstrates extreme seller confidence, but more importantly, it demonstrates a buyer's willingness to meet those confident sellers at much higher price points.
The leading indicators are unequivocally pointing upward. That realized value contraction you mentioned earlier, the drop to $445,830, that's a lagging indicator. That reflects deals that were negotiated 30 to 60 days ago in the dead of winter. The forward-looking data shows a market that is aggressively accelerating its pricing, not contracting.
That's a compelling argument. But have you considered the fundamental difference between a wish and a realized valuation? A list price, even a pending list price, is essentially an opening bid in a negotiation. It reflects the seller's optimism, certainly. A buyer might even agree to that $504,000 number on paper just to lock down the house and beat out the competition. But it does not definitively prove the market's fundamental valuation is actually increased until the appraisal clears, the financing is approved, and the deed is recorded. And we have compelling evidence that those fundamental valuations are, in fact, stalling out. Let's look at the RPR median estimated property value for Halifax. For the listeners, the Realtor's Property Resource essentially runs a massive valuation model, an algorithm drawing on deep public records and MLS sources to estimate what the town as a whole is worth. And for February 2026, that estimate sits at $587,870. That represents a 0.1% decrease from last month. It's a slight dip, yes, but it completely arrests the narrative of a skyrocketing trajectory.
You're putting a lot of faith in an algorithm over actual signed contracts.
Because the algorithm tracks the underlying value. While sellers may be listing new pending properties at $504,000, the algorithmic estimation of the town's overall property value is flatlining. This suggests something very specific happens between the accepted offer and the closing table. Buyers are successfully pushing back on those ambitious list prices during the inspection and appraisal phases. If a house appraises for $480,000, that buyer isn't bringing $24,000 in cash to bridge the gap anymore. They are renegotiating. That is what prevents those 11% increases in pending list prices from translating into equivalent increases in fundamental realized value.
I'm not convinced by that line of reasoning because algorithmic valuations like the RPR estimate often struggle to account for the micro-level realities of a highly constrained local market. Algorithms smooth out the data, they look at macro trends, which completely obscures the intensity of demand for specific property classes right in front of us. Let's step away from the macro-level averages, the algorithms, and the broader data sets for a minute. If you want to see what this supposed affordability ceiling actually looks like on the ground, let's examine a specific realized transaction from this February data. Look at the sale of 8 Bow Street.
Okay, let's talk about 8 Bow Street.
It's just the perfect case study of what is actually happening in Halifax. 8 Bow Street is a 1,056 square foot, 2-bedroom, 1.5-bath ranch built in 2008. It is explicitly marketed as a great condo alternative, which is real estate speak for a very small starter home. And despite falling out of contract previously due to buyer financing falling through, it sold on February 21st for exactly its list price of $434,900. When you break that down, that is $412 per square foot for a 1,000-square-foot ranch. This property proved its value because it was meticulously updated. It featured new paint, shiplap walls, a first-floor laundry, and a brand-new furnace installed in November. Crucially for this area, it already passed its Title V septic inspection, so buyers don't have that looming anxiety of a $30,000 septic replacement hanging over their heads.
The fact that a modest, entry-level 1,000-square-foot home can command over $430,000 and hit its list price exactly, even after a major financing hiccup, proves that the demand for turnkey homes in Halifax is absolutely voracious. The buyers at the entry level are fighting tooth and nail for whatever scraps of inventory they can find, maintaining the extreme seller advantage.
I am really glad you brought up 8 Bow Street because I look at the exact same transaction and I see a neon sign flashing market caution. Let's look at the specific circumstances of that listing. As you noted, the property was pristine. The listing remarks literally state, "Nothing to do but move in." It is a fully updated turnkey property. But look closely at the listing remarks. They also explicitly broadcast in all caps, "Sellers are motivated." Now ask yourself, in a hyper-competitive, unquenchable buyer frenzy where sellers hold all the cards, why is the seller shouting that they are motivated? A fully updated, sub-$450,000 turnkey home with motivated sellers does not sit on the market. Yet 8 Bow Street racked up 64 days on market. The median time to offer was 53 days.
But we know it fell out of contract.
Yes, it fell out of contract, but if the buyer pool was truly voracious, a property like this would have been subjected to an immediate bidding war the second it came back on the market. That bidding war would drive the price well above ask, and it would insulate the seller from a buyer with shaky financing because there would be 3 cash offers waiting as backups. The fact that it fell through due to financing, had to come back on the market, and took over 2 months to finally close at exactly list price not a penny above it, shows a massive fragility in the buyer pool. It suggests that while buyers desperately want homes, the buyers operating in that mid-400s price tier are stretching themselves to their absolute financial limits. They don't have the deep cash reserves to cover appraisal gaps or guarantee financing if interest rates tick up a quarter of a point.
When a perfectly turnkey home with highly motivated sellers takes 64 days to move, it completely undercuts the narrative of a two-day frenzy.
I see why you emphasize that 64 days on market, but we must contextualize that within the actual mechanics of a real estate transaction. When a deal falls through due to financing, the days on market continuously accrue. The property is stigmatized slightly by that back-on-market status. It naturally causes subsequent buyers to pause and wonder, wait, is there an issue with the home itself? Despite that systemic disadvantage, the home still recovered its full list price. That is a testament to the resilience of the seller's position in this market. Let's widen the lens back out for a second. The total market volume for pending listings was nearly $4.5 million across just 11 properties. When you combine that pipeline with the undeniable math of 1.38 months of inventory, the architecture of a seller's market is firmly intact. Sellers who understand the specific demands of the Halifax buyer, meaning homes that have passed Title V, have functional modern utilities like a new furnace, and are presented well cosmetically, are realizing incredible returns. The 101.2% sold-to-list ratio across the board validates this. It is a market where precision execution by a seller is rewarded with hyper-accelerated timelines and premium pricing.
But that is exactly my point. Precision execution shouldn't be a strict prerequisite in a true seller's market. In 2021 or 2022, you could list a property with deferred maintenance, an old roof, and aspirational pricing, and the sheer desperation of buyers would rectify the seller's overreach. You'd still get a bidding war. What the Halifax data for February 2026 shows is a market demanding perfection from sellers just to achieve baseline historical expectations. The median sold price dropping 4.1% month over month, down to $445,830, cannot be ignored. The public records median dropping over 20% to $349,900 points to a substantial segment of the market transacting at significantly lower tiers. And furthermore, the fact that active listings are aging with the average sitting at 84 days and higher-priced homes sitting for up to 145 days proves that buyers are finally exercising their ultimate power, the power to just walk away. They are no longer willing to underwrite seller overconfidence. We are transitioning away from a seller-dictated market into a highly negotiated market, where the constraints of high interest rates and absolute affordability limits are finally forcing sellers to compromise.
You make a highly compelling case regarding the limits of buyer capital. It highlights exactly why looking at a single metric in real estate can be so misleading and why we have to dig into the layers like this. We've examined a fascinating tension today. On one side, my perspective highlights that 1.38 months of inventory creates a structural reality that virtually guarantees a mathematical advantage for sellers. You literally cannot have a buyer's market when there is nothing to buy. This is supported by the 2-day median time on market in RPR and a sold-to-list ratio that continues to hover above 100%. It is a market that moves with breathtaking speed, provided you play the game correctly and bring a polished product to the table.
And coming at it from the other side, my perspective emphasizes that the era of blind buyer desperation has concluded. The dropping median sale prices, the flatlining algorithmic valuations from RPR, and most importantly, the aging inventory of active properties show that buyers are effectively dictating the price ceiling now. The case study of 8 Bow Street perfectly encapsulates this complex reality. A home can be wonderfully turnkey and eventually fetch its asking price, but not without revealing the financial fragility and caution of the current buyer pool over a drawn-out 64-day process.
Indeed. What this data ultimately reveals is that nuanced local real estate analysis requires holding multiple truths simultaneously. The gap between a frantic 2-day market for perfectly positioned properties and an 84-day slog for slightly overpriced ones proves that the Halifax market in February 2026 is intricate,
demanding, and highly sensitive to micro-level variables. There is certainly much more to explore within this material as the spring market unfolds, and we will be watching closely to see which of these trends ultimately takes hold. If you have any questions about this episode, or if you are thinking about buying or selling a house anywhere on Boston's South Shore, from Southie to Sagamore, give Jim Aldred a call. He would love to speak with you. Jim believes that people in transition often feel anxious about buying or selling a home, and he provides them with the guidance and security to help your family move on smoothly.
Thanks for listening, and catch you on the next episode of the Pink Door Podcast.